trade it for you, yeah, do not do that, please.
Sorry, I'm zoned
So,
out
and
right
if you
now
have somebody
because
reaching
I'm
out, would you
setting
take a
this up for the first
screenshot and
time
send
in
it
a
to me?
while.
Okay, so having
on
said
Ninja
that,
Trader, so
know that options carry a high level of risk and aren't suitable for all investors.
make
You
sure I
have to
set
meet
this up
certain requirements in
pretty
order
well.
to trade options with Schwab. So you have to apply for option trading privileges, and not all will qualify. You want to take it with options, and we trade both
Nearly
stocks
hit
and
TP2,
options
back
in
at
this class.
TP1 now.
But with options, there is a transaction
Gotta
fee,
make a
65
decision.
cents a
Are we gonna-
contract.
are we
You've
gonna
got to
hit
take that into account. You've got to
246 on
understand
this
the risk
entry,
you're
or we not?
taking. And what we're going to focus on today is looking at how much risk we're taking in a trade, and then how much return could we possibly make by placing the trade. And, you
make
know,
sure you
is our
tap in.
return
Shout out
on
to
risk
Lou.
worth it?
Shout out to C Black,
And you know,
Buddha,
do we have a
Bam,
set of guidelines or
everybody
rules? Do we have a
rocking
trading
and rolling in
plan
the trade
that
room right
outlines,
hit TP2
you know, how
one
much
time,
return we're
payment for
looking for,
lifetime access
you know,
for
taking
our
a certain amount of
community.
risk.
And,
So we do have lots of first timers here. I'd like to welcome all of you. For those of you who I affectionately call the usual suspects, you know, Life in the Fast Lane and AP 514 and, you know, the rest of the gang, I just want to say I appreciate your patience. I'm going to go over a couple of things that are a little more basic today, you know, on just how to find things on the platform for those that are joining us here for the first time. One difference is I want to use Paper Money software application on the Thinkorswim desktop platform. If you haven't downloaded that, you'll want to consider downloading the desktop platform. You know, and following along. But one of the differences is that a short option will never be assigned early in Paper Money, and that can happen in a lot of accounts. It's not always necessarily bad news, but it is news. It is something you have to be aware of, and it's something you don't get to practice in Paper Money. So I often talk about what we do if that happens, depending on the type of trade that we're placing. Okay, so what is on the menu for today? We always go out and do a quick market overview. We are going to place a new example trade, as we always do, and we're going to manage a couple of existing positions. So that's what we're up to today. One thing I do want to point out, if you are new and you're saying, you know, hey, this looks interesting, and what other classes do you offer? The desktop platform works on a Mac and on a PC. So, but if you are brand new and you want to see the schedule, and I put a link in, go to schwab.com/schwab-coaching. It brings up the schedule. And so you can see that today, you know, we're on trading a smaller account. Then we have, you know, James Boyd, who's fabulous, teaching trading with technical indicators. Then trading protocols for quick like fair one. So you can go in and see and sign in. Now, the way I access classes is I come and you want to subscribe, but I come out to the YouTube Trader Talks from Schwab Coaching. And then you'll see when you first come in at home, it'll have the class that is currently being taught, or the webcast currently being taught, and you can just click on it, bada bing, bada boom. Now, I am going to talk about some trading strategies today, both a long call vertical, a short put vertical, and perhaps even a long put. If these are new to you, you might want to check out trading a smaller, getting started with options, and we meet every Tuesday at high noon for that class. But if you click on playlist and then scroll down to the very bottom, you'll see in the second to last row, getting started with option series. If you click on full playlist, you start with the basics in week 1, but then there's a whole class that is dedicated just to long call verticals, if that's a new strategy for you, or just to short put verticals. Also, we're going to talk about a covered call this week. It's another class dedicated to covered calls for verticals. So if any studies are new, here's a handy place you can go. Also, if you are new to the Thinkorswim platform in general, if we come back to these playlists, the playlist menu, there are 2 or 3 classes that are taught just on getting started with Thinkorswim or Thinkorswim tips. Brent Morse teaches one, you know, using Thinkorswim Web. He's got a series if you want to look at Thinkorswim Web. If you're coming over from Street Smart Edge, there's a webcast dedicated to that, you know, if you were in Street Smart Edge, here's how you do things in Thinkorswim Web or in Thinkorswim. You know, start here, Street Smart Edge to Thinkorswim. I also created a bunch of little mini sessions, and the ones in turquoise are all like 10 to 12 minute sessions on, you know, how to customize your monitor tab, or how to add a script, or how to customize a watch list, or customize your charts. So those are some additional resources you may also want to consider using. Yeah, Jennifer's saying, I think I'm supposed to be in that beginner class. So it doesn't mean that you can't stick around and kind of see if if this wets your whistle, but we do move tend to move very quickly in this class. And we place a lot of trades. And so both the getting started with options class, I created the class that I would have wanted to attend when I was learning how to trade options. And then once I kind of felt that I had a bit of a handle on it, this is the class that I wish, you know, had existed, you know, where we just placed lots of trades and followed up on lots of trades. So that's what we're going to do. Okay, so let's go out and have a quick look at the markets. So when we come in, and you know, we started with 20,000 back at the beginning of November. And at the end of this calendar year, I will wipe the slate clean and we'll go back to 20,000. You know, but it's done quite well. Like we're at 33.8. So if I switch this gadget to a calculator, we're up, I think, around 70%. And that's quite extraordinary. Is that typical? No. And one of the advantages we have is that this is not real money. So, you know, you don't have your emotions, you know, and as I say, you know, hope is a bit of a four-letter word in the world of trading. And so we tend to take a very disciplined approach to how we trade this class, but it's done quite well so far, up about 69%. But let's go and look at the S&P. And, you know, if we look at the SPX, and we look at, if I change this to show price as a percentage, if we bring up the last year, it's up about 23% in the last 12 months, and up almost 15% year to date. Now, since the S&P 500 was established, like in the early 1920s, on average, it has returned about 11%.
We had a buy momentum.
Yeah, so how many years have I spent in this market? I came to this education in 2011, so I've been doing this now for 13 years. Linda is saying, is that year to date? No, that's since the beginning of November. Typically, that's a year to date number, but we started at the beginning of November. Yeah, hope is a four-letter word. In the world of trading, I do hope is a four-letter word. It's not a strategy.
I need to see those
you know, it's not a strategy. Neither is FOMO, and neither is fear. You know, and fear can sometimes lead to hope. Like, ooh, I'm afraid I'm botching this one, but I'm hoping it'll turn around. Hope isn't a great trading strategy, and that's why we have trading plans. And you'll notice if we go back to those mini sessions, just for one hot second, at the very top, and eventually there will be a dozen or more of these. There is an example trading plan for the long haul vertical type trades that we're going to place today, and for short put verticals. And so, you know, this is not, you know, the IG. It's just a framework that you can use from which you can then create your own trading plan. And we kind of go through that. And these are a little bit longer, 17, 18 minutes, as opposed to these ones here on the Thinkorswim platform are typically between 9 and 12 minutes. Okay. So back to our regular programming. So year to date, we're up 15%. You know, on Friday, we hit a new intraday high for the market. So it's hard to characterize the markets as anything other than bullish, right? Right.
If you want to get
with the S&P, you know, hitting a new all-time high on Friday. How about the NASDAQ? So the NASDAQ 100, this is a tech-heavy index. There are no financials that are part of this group of 100 stocks, and it too hit a new all-time intraday high on Friday. And you know, it's up 30% in the last year. And if we go back to 2 years, up 70% in the last 2 years, like extraordinarily bullish. So it's pretty hard to characterize the NASDAQ as anything other than bullish, up almost 18% year to date. Now the Dow 30, the difference between this index and the other two is one, like the S&P has 500 stocks, the NASDAQ has 100, this has 30. And their weight as part of this index is based on the price of the stock rather than the then it's market capitalization rather than the size of the company, which is what the other two indexes use. In year to date, this one has kind of spent a lot of time going a whole lot of nowhere. It's only up 4% year to date, but in the last 2 years, it's up about 27%. In the last 12 months, if I just change my time frame, it's up 14%. You know, so certainly bullish. And then our Russell,
like I said,
you know, in the last year, this one up 8%. Year to date, it has gone basically nowhere. So if I pulled up a year-to-date chart
entry that we got
and I've created a time frame, you can see we started here and we're basically at the same spot. You know, so year-to-date we're not up quite 1%. We've been consolidating. But the range is, we're in a tighter range than what we have been over the last 2 years. If you come back and look, we were in this range coming down to about 1630 and going up to about the 2000-ish range. So far this year, we've been kind of more in this 1970 to 2100 range.
You can't get access to
you know, but this has been the least bullish of the four indexes. And then if we come and we look at the volatility index or the VIX, we can see that we're at the very low end of the range that we've been in for the last 2 years. So I'm going to take this and change this side back to showing us a price.
Into profit right now, nearly hitting TP3. I think we just about hit TP3 actually.
Oh, somebody's saying it's up about the same as groceries.
Officially.
Let's start on a more positive
live
note.
In the markets right
but
now.
Chuck, I hear you.
I don't know what else to say, but I said I was going to stop talking, so I'm going to sit back.
I was in Costco in Vegas last week, and the last time I bought a bottle of Dom Perignon, and it's not something I like. To drink something that expensive just seems crazy to me. It was $129 or $115. On Wednesday of last week,
has officially been smashed.
That's crazy. Not a typical grocery item, but do you have sessions that deal with trades that have both targets and loss exits? And Harry, the answer is yes.
360 ticks
so we have a target and a target exit on pretty much every strategy that we trade.
Market's looking like it took a blue chew.
So let's
go.
Take one look at one other thing. We're going to come out to public and S&P 500 sector indices. And if you're wondering how I got like this on the charts, I'm not going to take time in class to go over this, or how I got these scripts. These are scripts that give me a 4-week return and a 3-month return. And then I customize this by hitting the sprocket, because I have no idea what SP 500 hashtag 10 stands for. It actually stands for the energy sector. But what I'm going to do is sort by 4 weeks and what has been the #1 sector. Technology, and followed by consumer discretionary, and then communications.
Headed to TP4.
You know, and then what about over the last 3 months? technology, and I've also linked
it's
my
only right
chart
that we set up TP4. Let me set
to
a
my
screenshot for TP3.
my watch list. So when I click on
That's
technology,
let's go.
we can see, and we tend to trade in a shorter term time frame in this class. So let's look at a 6-month time frame. We can see that this has certainly been uptrending, right? It's up almost 30% year to date. Communications up 26. Utilities. Now utilities, you know, is in third place, but it was really crushing it, and it's now giving back a lot of its gains. Yes. Yeah, and this is paper trading, and this is a brilliant place to learn. But you know, it's you're not trading real money. It looks like, smells like, feels like it, and shows you how to use the platform. But it's not a live account. And so over the last 3 months, again, technology and communications leading the pack. Consumer discretionary in 4th place, but it was kind of consolidating and now looks like it's broken out. So we might want to go back and look at some more consumer discretionary stocks like the Amazons of the world. And in fact, speaking of which, let's bring up Amazon.
The reality of the situation is that
and we could just close this out altogether, but I may want to use this calculator. But so let's come and look at Amazon.
Global and profit right here, so.
Yeah, somebody's saying that it's kind of like training wheels on a bike. Yeah, these are great training wheels. So Amazon up 30% year to date, in spite of the fact that from the end of March through almost the end of June, it's been kind of consolidating, hasn't it? And kind of going in this sideways range.
Floating right now.
And so some people might look at this, and if you're new to looking at charts, we call that technical analysis. There is a class called Getting Started with Technical Analysis, and it's taught on Tuesdays. You might want to check that out. But if we're playing I Spy with my little eye, some might say, well, I see kind of what we call a double bottom here, and it's gone from 179 to 190, 175 to 190, so about a $15 range. So a technician might expect it to then go up another $15 to maybe 205. Now, how long that will take, I mean, we don't exactly know. But that's if you're looking for an estimate, some might use that as an estimate. Now, others might say, well, you see a double bottom. I see kind of a cup and a handle. There's the cup, there's the handle. But both patterns would measure this distance the same way and the target the same way.
Let's go.
And so could we look at this? It's broken out. It pulled back for one day. That day was Friday. And today, this candle pattern is called a harami. And this is still a live candle. But what it means is that this candle today is inside the body of Friday's candle. And if that happens close to a support level, some might argue that that's a bullish signal. And so what might we do? Well, first, I'm going to just try and avoid confusion by wiping the slate clean. It broke out here at 190. We do have earnings coming up, and if we click on it, which I can't do while my drawing tool is live, but when I clicked on this, it's saying earnings is coming August 1st. So could we do something that's kind of modestly bullish, or I call a bullish to neutral strategy? Could we sell maybe the 190, sell a put at 190, and then define our risk by buying a put below it at maybe 185? So, and the answer is we could do that. That's called a short put vertical. Now, a short put vertical, depending on where your strikes are, can be a higher probability than some trades, but tends to have a lower return on the amount of risk we're taking. Or could we look at this if it's at 196.6? When I looked at it first thing this morning, it was at 195. Could we come out and say, well, I'd like to do a long call vertical and maybe sell a call, or sorry, buy a call.
Click the link and tap in. We just launched this
around the 195
trading system here.
And then because that might be expensive, and remember, like in this class, we don't want to risk more than about $500 on any one trade.
The trades, and
so if we don't want to risk more than 500 and the call costs more than 500, we might kind of bring our expenses down by selling a call above it. And if we do that, that's called a long call vertical.
What happened here came down.
And this is a little more directional in that it has to go through both strikes in order, and then stay above both strikes in order for it to be profitable. With the short put vertical, if it goes sideways, if it goes up, we have a profitable trade, so it's bullish in that regard. If it goes sideways, we have a profitable trade, and depending on where we sell our strikes, it's at 196. If I can sell the 190, I have $6.61 worth of wiggle room before I'm in big trouble.
Another one was 26.
Okay.
This one was my live account.
Now, why might I consider a selling strategy than a buying strategy? And I want you guys to think about that and type into the chat why some might look at this week as you know, a good week to sell.
It's that easy. I didn't think it would ever get that easy.
So think about that. Go ahead and type it into the chat.
We figured it out.
So, and let's come out to the trade tab. Well, you guys are busy clicking away. So if we look at July 19th, that's only 18 days to expiration. And so what's the advantage of a shorter time frame? The advantage is that we're already in that 3-week window, so time decay is going to be working at an accelerated rate, and the value of our option is going to decline quickly. So if we're selling something, we want to get paid high and then have it fall in value.
This is it.
Yeah.
Shout out to everybody.
You guys have got it. It's a short week. So we're closed half a day on Wednesday, the market is, and all day on Thursday. And then Saturday and Sunday we're closed also. And so, you know, we have 3.5 days where the market is closed, and yet time decay is still ticking away. And so that makes, you know, the idea of selling sound infinitely sexier. But if we look at this, if we did the 190, 187.50, we get paid 59 cents a contract, or $59. And you may say, well, that is not going to have me sipping something interesting out of a coconut in Tahiti. Yeah, no, you're right, it's not. But if we're only in this trade for 18 days, and if you go and you look at our trading plan, you know, there's a what to buy, when, you know, or what to sell, when to sell, and how much to sell. So, you know, our parameters are, you know, in this example trading plan, does it trade 1 million shares a day or more? Check. When you look at the strikes we're looking at, does it trade at least 20 times the number of contracts we want to trade? Well, we wouldn't do more than 2 of these, so that's and then do we have a tight bid-ask spread? And we want it to be less than 10%. It's a nickel, and it could be 18 cents, so check. And what's our delta? Our delta is 25. And what does delta even mean? It means it's $1. The value of the option goes down to 25 cents. And some people will use this as a proxy or kind of a general rule of thumb for, you know, the probability of this being a successful trade. And some want to look for a delta between 20 and 40. The probability of this being in money on July 19th, 18 days from now, is about 27%. So we have a 73% chance that it's going to expire worth. Given where it's sitting right now, there's a 55% that it's going to sometime between now and then. So we decide, are we going to freak out or not? Yeah, you're not. So because you know that there's a 55% chance it could do that. I still want to do when you talk about risk. How much risk are we taking? Well, we get paid 57 cents. And when I first looked at this morning, it was paying 67 cents more. But we're risking $1.93 because the most we can lose is the difference between the strikes. And so if I come up with this calculator, and I say, okay, if I can make $57 on a contract, and I'm risking $1.93, which is 250 minus. What kind of turn on it? Well, it's about 29.5%. So around that 30. We wanted the rule of thumb, it never to be less than 20 to 25%, but if it's in there for say 5 days, and typically we're looking at 20 day time frame, so this is a shorter time frame, well then at 29% potential return for a trade, we'd be in for 18 days. Now, if we go for the time, what are you thinking of? Do it kind of more premium. So right now we're looking at 18 days. The dollar is at 26. Now I have to do a $5 wide for it. I get $1.37 on $5. If I got 19, I get 98 cents, so I can get more. But if you have a small account, and we like this idea of smaller time frames, or the shorter time frame, or the tighter bid-ask spread, we might, that might not be as appealing. And we're going out, we're going to pay 40 cents more, but we're going out like almost 50% longer. It's another whole week, so instead of being, this 2 weeks and a bit, 18 days, just over 2 weeks, we're going out that extra week. And somebody else say 45 days is the sweet spot. So let's look at 45 days. So if we're at 190, 195, 190, 185, line 19, and the 26, if we look at the 26, so that's 25 days, we've got $1.38. If we come out to August, which is closer to that 45 days, if you just look at our time frame. Now, $1.36, $1.75. I'm only getting like 175 minus 36. I'm going out twice the amount of time. I'm not getting anywhere close to the double the premium. 175 minus $1.36. I'm getting 39 cents. And so, and then it's going to take a lot longer for time to kick in. So there are many that would argue, I'd rather do 2 20-day trades than 1 40-day trade. And we don't want our rules. Now, some people will do this as an earnings trade. Others will say, nothing to trade is over earnings. Why not? Well, because some stocks came down on earnings. So here's Amazon that gapped up, so that would have got us to our max gain earlier, and then it gapped out. And then if we had a short vertical on, we could have had max loss. And the same thing, we've seen this happen many times. And so that's kind of part of one of our rules, given that we actually see pretty quickly. So with Meta, so if that's on support, and then on earnings, you would more likely given it up, or you can predict the second gap down, back off. So that's anyway, I don't have competition over 2 time. So when you look at, we could easily come out and do and earnings offers, and earnings, then the fleet has to go up. So going to 19, what's the advantage? Is that it's double that. Which is 22. That might be great. So we're at 6 cents, 25% on rest. And you're looking at say, hey, if this, when it's down to 6 cents or 10 cents, so 80% of saying, I have both sides. We know that. And we're seeing $190 contract with 2 of these. So 122, which means how much risk we're going to make our assets, triple cancel, for percent. So we're looking to sell to short verticals, 190, 20 cents each, trading at 190, so we have $1 going. How much is $190 on the minute, and we're going to get short verticals. Now, what do you do? And you're looking and saying, hey, how come that's going in? Could we also do a long call vertical? So we're counting that 196. Could we come out? And we come up to this July 26th, it's still, now if volatility is going up, does it help us? We're buying something, it was something, so we wanted that to go down. So if we come up to July 26th, we do a 195 and 200, so we're buying 195, which is lowest and already in the money. Our target is to go above 2% and stay there. So we're going to look at buying a vertical. We're paying $2.35, so how much would we lose? $2.38 or $2.40? And so how much would we make? Well, if you're not going to do the math, if you come up to the confirmation, it says it could be 238, it could make 260, so we could make over 100%. But our kind of option is class, we don't want to be agreed. So our goal is to make 50%.
One of those may
so,
be
that's a pretty nice turn on our risk.
Kind of the fear from what we're seeing, on cloud is continuing to do extremely well.
That's a pretty nice return on our risk. And so if we come in and say, okay,
attack night, we're far from
and again, the probability of it coming up, it's already above that. The probability of it hitting 200 is 84%, and the probability of it being in the money at expiration is 40%. Oh, this is July 6th. So,
from that, and at some point you say, okay, this may be a little too far. This company is still has a little bit of innovation.
We're buying vertical, 235. So let's take 235, multiply that by 1.5, 50%.
At some point turns into an
so when we get, when this is worth about $3.53, we'd like to buy it back. And if we can risk $500, how many of these can we do? We can do 2, single order, with first order sequence. Now, if you wanted to put in an OCO, you can. But we tend not to do this in this class, but we do, however, is we do look at these every day, and we say, hey, if this is close to 50% loss, or if it goes above a 50% loss, we're going to exit the position.
If they turn that around,
so we're going to create an opposite order,
so at some point as an investor,
and put this in at 352.